Welcome to the Broken Pie Chart Podcast, episode 261. I'm your host, Eric Moore. With me once again is my semi-permanent co-host, Jay Pestrichelli, CEO of ZEGA Financial. Jay, what's going on today?
All right, before I get into what's going on, I'm just going to say I think I missed congratulating you on your 5-year anniversary, right? So at 260, that's 52 weeks times 5. So you've put out at least 5 years worth of podcast, Eric. So congratulations on that. So not everybody sticks with it. You are absolutely sticking with it. So congratulations on that. Great work.
Yeah, thanks. I didn't really catch that, but you're good with you're better with the prime numbers and the numbers and all that stuff.
I stopped doing the primes. You thought that was no value. So now I'm bringing up your anniversary. But speaking of numbers, Derek, this is the 6th week in a row that I'm going to say another week and another new all-time high. We even closed the week at an all-time high on the S&P again. I mean, it's getting a little old, right? I told you I was going to keep track of it, but there we go. I think I saw a statistic on Bloomberg that the market has been up 15 of the last 17 weeks. 15 of the last 17 weeks. This is a fairly uncommon occurrence. There is plenty of optimism in the air, it feels like.
Yeah, well, and don't we have the ridiculous, I'm not going to call it a wager, but I said the market will get to 5150 before it gets to 4950. Is that you took 4950?
It was 4900. It was 4900, 5150. And looks at when that happens, you're playing Van Halen. I don't know how you're going to work it out and get the right copyrights, but you're playing something off.
You're going to get me thrown off the air.
Why can't this be love? You're just going to crank it up there.
Do you remember when Conan O'Brien, when they took the Tonight Show away from him, and that last week before he was off the air, he was showing unpaid for NFL highlights? He's like, this is going to cost NBC a ton of money, but I don't care, you know?
They'll just take it down. Maybe if we could find a bootleg version and do something in honor of 5150.
I think there's actually, if it's so many seconds or less, then you can play it.
Okay. All right, we're going to work it out.
I'm going to find it out.
That's going to be look. You're going to win the bet, and then you're going to have to do more work. So congratulations on that.
Yeah, congratulations to me. All right. Well, the other thing that's up is, and by the way, I'll just mention to the audience, we're not trading off that. Trust me, we buy and we hedge.
We're happy to be invested in the market, right? Not timing, time in, not timing, kind of that kind of right. Trying to pick tops and bottoms. You want to be in the market because over time the markets tend to go up and you get these runs, and while maybe nobody thought this was going to be the run when we bounced off 4,100 I'm looking at the day. It was October 27th, and you're up 1,000 points from then, right? That's pretty, rounding that math out, it's 25%, 24% we're up. Not bad.
Not bad. Not bad. You know what else isn't bad? Nvidia. Let's talk about Nvidia.
Yeah. I mean, how can you not? It's the big talk, and it's probably driving a lot of this move.
They are on the doorsteps of being a $2 trillion company. So it's called the market cap for anyone who's not familiar with this, but we like to teach on this program. You take the number of shares outstanding times the stock price, and that equals your market cap. Microsoft is 3.06 trillion, Apple 2.85, Nvidia 1.96 trillion. So it's third.
They're ahead of Amazon, Google, Meta, right? Mm-hmm. So they're number 3 now. Is that what you're telling me? Third largest company.
Third largest company. They're number 3. That's right. That's right. And it's, they're up quite a bit. And I was going to do this later, but since I'm talking about market cap, imagine that Microsoft and Apple and everybody else just stayed flat, didn't move over the next year. Nvidia would have to go up about 56% to reach a market cap of 3.06 trillion, assuming that no share buybacks, no share issuance, and all that type of stuff. There's about a 14%, 15% probability of them doing that over the next year based upon the options market.
So there's still a decent gap between Nvidia and Apple and Nvidia and Microsoft. Like 56, 52%, whatever the number was you just said, is still quite a bit of appreciation. But I think Nvidia is up 50% this year, right? Almost?
Oh, yeah.
Close to it?
Oh, it's got to be. Well, look at their 1-year earnings growth too. Their 1-year earnings growth, they're up 584%. Their earnings have grown. Microsoft is 0.21% 1-year earnings growth. Look, this is what happens. This is why we say buy the index, though, because over time, different companies are at the top of the index, and then maybe they fall out of favor, whatever. Or new companies come along, and it's sort of this morphing thing that always happens, and that's why you own an index, because it just sort of self-selects this. So I don't know. All right, Nvidia, Jay. This is one of those things where a lot of people are calling it a bubble. I'm going to speak for you for a second, and I normally wouldn't do that, but neither of us know what the stock is going to do in the future. It could be a bubble, it could not be a bubble. Who cares? But we know it's been going up quite a bit. Goldman Sachs had a graph, and we've talked about PE ratios. PE is your price divided by the earnings per share. So if you're trading at 20 and your earnings per share are 2, you're trading at a 10 PE. And there's a forward PE, meaning what's the next year's estimates by the analyst, and your price divided by the next year's analyst expectations. You can do a trailing PE. What's the price divided by the previous 4 quarters earnings? Jay, in Goldman Sachs's chart, they show a couple of things. They show since 2019, the average forward PE, forward meaning what's the estimates going forward, are about 40. And what's kind of interesting on this chart is as Nvidia's price has gone up, Nvidia's forward PE has come down. And I know you looked at this and you had some thoughts already. So I'm gonna turn it to you, and I'll come back.
Yeah. So when you think about this, right? You mentioned the components: price divided by earnings. There's 2 things there, and we all just talked about we all know, and we just talked about how the prices increased so much this year. Yet the price to earnings has come down, right? So it's where is it landing right now, Derek? Like the PE ratio is where? Somewhere 35-ish. Kind of, is that the range?
Yeah, on a forward basis, it's right around 33 times next year's earnings.
But the average is 40, and there have been times where it's been over 60, correct?
Correct.
And so in order to get that PE ratio down, the E in the denominator, sorry guys, 3rd grade math here, the E in the denominator has grown faster than the P in the numerator has grown. And so this has dropped. And so if you were just not knowing anything about what was going on with the stock itself, you would look at this and say, compared to its historical pricing, it's probably cheap, right? You could have more appreciation in the price and you'd still only be at the average. And I'm not saying go out and buy Nvidia right now because it's a forward estimate, right? It's not a trailing, right? It's kind of looking forward on what they're assuming is, or they're projecting is going to happen with the stock. And we all know that there's plenty of reasons that could go wrong, or where something could go wrong versus their projection. But yeah, this is fairly cheap. So while the stock is at, this all-time high, to see the forward PE multiple come down is quite a thing. I think this is, fairly rare. And it's because why? Because their earnings expectations have grown so much. And it also means that the street wasn't really properly projecting the earnings, right? The E was understated before, and now it's shooting up, pretty dramatically, which is causing this ratio to drop, right? So again, price divided by earnings, all the driver. Everybody knows how these metrics work.
I'm glad you brought that up. And while this might seem new to a lot of the audience, wow, has any stock ever? Remember back in the early 2000s, companies like Amazon and Google and Microsoft, they all, let's say maybe not Microsoft as much, but Amazon certainly had a high forward PE. But if you bought them, they sort of grew into their earnings, meaning in hindsight, it was probably cheap. Now, there's plenty of companies that were, got cheaper or got worse, but I think you said the key thing, Jay, there, that these are analyst estimates going forward. And analysts have under forecasted, let's say, we just sort of gave it away. What are their earnings up 500% year over year?
Yeah.
It's crazy.
Yeah. Well, no, that's it. So this is the whole thing with this is if you thought like, oh, I'm going to wait for Nvidia to get back down to $500 before I buy it, or $600 before I buy it, which a lot of people obviously have been buying the stock in the last couple of days, which pushed its price significantly higher. This is not. It's not from this particular metric. It's not expensive, right? If for it to get back to its average, two things can happen. The P would go up, meaning the price would go up, or to get back to the average, it would mean the E would have to go down, right? So in order for the PE multiple to go higher, the denominator could either go lower, right? So the estimates would have to drop, or the price would have to drop. But would have to go higher. So I don't know. All those, I don't know. I think I just got that backwards, Derek. So clean me up if I got that wrong. But it's if you're waiting, something pretty significant is going to have to change if you want to hold this. Now, look, if you're, as you just said, Derek, if you're in the indexes, which is something that we always talk about, if you're in the S&P, if you're in the NASDAQ, you've got exposure to this, and you've definitely benefited from your exposure to this. Look, you're not up 50% or 60%, whatever it's up right now for the year, but a lot of the push higher, as I started out talking about the sixth week where I'm saying a new all-time high, you're getting that benefit from in that index. So you didn't totally miss it if you were waiting to buy it.
Yeah, no, I agree. By the way, thanks to Toby is the person. Thank you, Toby, who sent this over to me. It's a good chart. You mentioned, people already own this in the indices or the indexes. So if somebody has SPY exposure, you own this. If you own the Qs, you own it. So there's been this debate about whether there's too much indexing or whether indexing is going to, not allow for price discovery. And this is a good case to look at, because I guess if those not indexing are buying this stock, it sort of forces the indexes themselves, and i.e. the ETFs that own the indexes, to buy more of it. This is a weighted index, so the higher the price, the greater the market cap, let's say, the more people have to buy. So, and this is why indexes work too, because while they're not trend following, they're not technical analysis. It's sort of like the more momentum something has and the higher it goes, it sort of builds on itself. Like you want to own the stuff that's going higher, not the stuff that's going lower. But I don't know. Any thoughts on that?
Yeah, on the index, that's my thought. Generally speaking, right? Like this is like, I'll say this, and I've said this before. Like this is a little bit of it's not even a dirty little secret. It's kind of the unspoken secret about our industry, right? If you're going to do it yourself and you're not sure what to buy an index, right? Like it's the advice I give to everybody that doesn't have the need for specific advice or specific way that they want to kind of allocate their money, right? Generally, it beats most money managers, right? Buying the S&P over time will beat most money managers. I'm not the only one giving this advice. Warren Buffett gives that advice all the time. I think, isn't it Berkshire this weekend as well? I think they might be having.
Is it this weekend?
It could be. I think I saw some stuff come out about it. But so like, look, that's it. Like if you're the do-it-yourselfer, right, just you will be hard pressed to outperform the S&P 500 over time, right? It's the advice I give to everybody who's just starting out, who's got a little bit of money saved. It's not until you start to get closer to the time when you're like, look, now I have cash needs, or I have some protection needs, or, hey, I want something that's more aggressive than the market because I've got a slice on my money that I want to outperform, that you should get, some professional management. But, we're believers in hedging and protecting, and that is because at certain times in somebody's investing life cycle, that's necessary. But for people just starting out, like the advice we gave the boys, the Gen Zers that were on a few weeks ago, right? Buy the index. It's fine. It's going to solve most of your problems. So that it takes care of a lot of these things here.
The S&P, the QQQ, the NASDAQ 100, most indexes, the majority of them are market cap weighted. So the larger companies. The Dow is the exception. And the Dow is a little bit weird because it's price weighted. So whichever company has the highest price, even if they're 1/10 the market cap of everybody else, they're weighted the highest. And I don't know if you saw, Jay, this week, was it this week or last week, Amazon is going to replace Walgreens in the Dow Jones. But it was the same time that Walmart is doing a 3-for-1 stock split. So when you do a stock split, that company's weighting is reduced because the stock price is one-thirded, right?
Only for the Dow, right? But the
Only
others,
for the Dow.
it's
Only for
different.
the Dow. Yeah, it's just weird. It's just, I know most people, we assume we say the market, it's the S&P, but they still show the Dow on like the morning news. I don't know why.
For some reason, those 30 stocks that they rotate through, people still pay attention to it.
All right. Good luck to the Dow and Amazon joining them. Jay, I want to continue with Nvidia, though, is just when you look at the earnings per share growth. So I think it was 12.96 EPS over the last 12 quarters. Forecasted is about 23.79 going forward. So that's almost 100%. The analyst expectations, the consensus is almost 100%.
Mind-boggling, right? I mean, just say that again, right? Like it was 13 and now it's almost 24. Like
correct.
This is, I mean, these numbers this quarter were, I'll add one thing, right? Everybody thought leading into this earnings announcement, the price was inflated, right? Like, it's going down. There's nothing that could sustain that move ahead of earnings. It's way too optimistic. And it was not, right? It actually was understated when you see numbers like this, when the EPS, basically is doubling.
Well, revenue is not quite expected to double, but trailing, so actual was $61 billion in revenue, and expected 4-quarter forward is about 107. So it's still pretty huge. That's a pretty, and their gross margin. So gross margin is it's basically your cost of goods. About 75% forecasted gross margin, which is huge. And even if I look at their net income, their trailing net income into their revenue, it's about a 55% net margin. That's pretty good. That's like,
I mean, it was 32, right? So net income, right? The net margin there was what? It was like 32%, right? So every
55. So 32 billion of revenue into 61 of 61 of revenue, net income of 32. So that's roughly 54, 55, right?
Wow. Yeah. There's just huge numbers on this thing.
And normally you'd say, well, if somebody has really high profit margins, that encourages others to come to the area. Like, hey, we're selling Coca-Cola, but there's really good margins over there, so we should do semiconductors. This is kind of more of a specialized thing where, if streaming services were netting 55% net profit margins, Coca-Cola would be like, yeah, I think we could do a streaming service. We'll find somebody to do it. It's
the Coke channel.
Yeah, you buy a 12-pack of Coca-Cola. You take the UPC code off the thing, and you get $1 off your streaming. They'd be in this business, but it's not the way it works. Now, if you go to 26, fiscal 26, 27, 28, I mean, they're not forecasting that same rate of growth, but it's still growth. I mean, they're still growing. They kind of get more of a terminal rate of growth, 27 to 28. But, and you mentioned we talked a little about the EPS and the forward price. The trailing P is 60.77, or at least it was, I think, yesterday. And the forward P, 32.76, Jay. Like 32.76, I'm not saying, who knows what's cheap and expensive. But when people say this is a bubble, like that doesn't seem like a bubble. What do I know?
Now, when its average was 40 and going into this earnings number, it was 60 PE, right?
60 trailing.
60 trailing, right?
Yeah,
and that was going in for 32 going forward. That's not bubbly.
Yeah. Watch the stock going on 500 points tomorrow. Good. Look, if you want to buy Nvidia, buy it. If you don't want to buy it, don't buy it. We don't know where it's going. But if you own an index, the good thing is you've experienced the growth through the index. And it's maybe we could mention that it gapped up. What did it gap up? About 11.19% after the earnings on Wednesday.
Earnings. Yeah.
Right. Closing that next day up basically 16.5%. And the S&P itself, because Nvidia is such a big component of it, it's the third largest stock. The S&P was up, what, like 1.7? Was it up almost 2% that one day?
Yeah, it was up almost 2. Yeah.
Yeah. So, all right. I want to talk a little. We usually use
one point on this one,
Yeah.
right? We talked about Nvidia going into earnings, right? And you talked about, I don't know if this is where you were going to go, if you're going to change topics, but we,
Go there.
talked about the options market making some level of predictions on Nvidia, didn't we?
I think we did. Let's do it now.
Yeah. Okay. So when we were talking about the skew, right? How calls look more expensive than the puts. So we said, like, even though, this has moved so much, the market has an expectation that'll go up. You mentioned the gap up of 11%, but where it finished, right? The next day, it was up, what, 16 and a half. So the options market, as frothy as it was, with what was like 180 implied volatility, which is very, very high. You only get that right around, an earnings or a big news event, right? That's normally it trades, 45, 50 of implied volatility, right? To have that more than triple, and it still wasn't enough, right? It ended up exceeding that move that the options market was predicting. So as much as it moved, and as much as, the move was kind of predicted for the size, it still was even significantly more. I mean, that's how big of a surprise this was. It kind of surprised everybody.
Yeah, I mean, it's. I would agree. The expected move, by the way, and let me make sure my math is right. I think what I put on my sheet is not, but you take the implied volatility 182.84 divided by the square root of time, which is the square root of 252. Why 252? Because it's the number of trading days in this year, divided by 15.875. So basically, the implied move is 11.5%. 11.5%. And actually, now that I look at my math, it kind of got the gap right.
It got the gap right. It's true. And I remember seeing it after hours going, it's a little short of where we think it may be. I remember watching, we were, one of our strategies that we run sells calls on.
Oh, yeah.
And so we had sold calls on Nvidia at the 810 level and 820 level. And we said, well, it looks like those calls are going to be, out of the money come Friday, but still a good move. Cover calls a bullish strategy, and the stock had moved up. So still good, right, for that strategy. But by the end of Friday, those ended, below 800. But at one point, those were in the money when it popped up to 820. So, like you're right, Derek, that the options market got the pop right. But then what happened after that, the continued move over the next, day and a half, continued to press higher.
Yeah. And to be clear, the 182 implied volatility was on the options that expired Friday the 23rd. Earnings come out after the close on Wednesday the 21st, meaning if you're buying or selling options before the close on Wednesday the 21st, you don't know what the earnings are yet, but the earnings are priced in. The expectations on the earnings are priced into those options that expire just 2 days later. So, I guess, with the covered calls is interesting too, because there, especially if you're selling more short-term covered calls, you're actually, this is where the short-term captures some of the excess premium. If you're selling stuff that's near to expiration, it's more reflected in, so you're getting paid based upon the earnings coming out. And then if your options are above where the current price is, you've got the appreciation and the premium received for those. I don't know if you want to talk about that a little bit.
Yeah. So the concept behind the cover call is you're willing to give up some of the upside to get paid for the kind of the expected move, right? The implied move. This is where the term implied volatility comes from. But you take all the downside risk, right? It's like owning a stock, right? All you've done is maybe offset by the amount that you brought in from that call that you sold. So that is the kind of give and take when it comes to a cover call strategy, which, by the way, cover calls have been around for years, right? It's the first option strategy most people learn. It's a strategy designed to generate income off of, the holdings that you have, option income, I should say, right? It's not, you're giving up the upside when you're in a covered call situation, but you accept that give up when you're selling that call for the income. That's your compensation, right? And if stock goes down, you'll lose less than if you had not done it. If the stock goes up, you may make less. You may make more if it doesn't go up too much, right? Like there is a sweet spot about covered calls when you understand the risk dynamic on covered calls, which is you're still bullish because you're still on the stock, right? The worst thing that can happen to you is not that the call goes in the money, it's that the stock drops significantly. So even if it goes up, and when we had sold those calls, I think we were 10% out of the money. In that scenario, if in 2 days Nvidia went up, 10 or 15% and it got called away, there's not a lot of traders that are upset making 10 to 15% in 2 days, right? That's a nice risk return ratio for you. But that's the give up. That's the dynamic of a covered call strategy where you get paid for giving up some amount of the upside. Now, the way you implement the covered call strategy can be very different, right? You could sell for the most amount of premium, which is right at the money, and you'll get no upside appreciation, just what you earn from selling the calls. Or you could give yourself some upside capture and get that income. That is the way we generally do it at ZEGA, unless there's a specific scenario where we want the stock to go at a certain price. And in that scenario, you want the most amount of income. But generally speaking at ZEGA, our philosophy is markets generally go up. We want to capture that, but we also want to get paid a little extra in that premium. So that's the idea and the risk reward of a covered call strategy. Look it up if you're not familiar with it. And even if you are familiar with covered calls, they get kind of interesting once your calls go in the money, right? Now, what do? We could probably do an hour on what to do when your calls
go in the
money. What to do. But that's where, 25 years of trading ZEGA comes into play. Really, actually, across our 5 traders, there's probably 140 years of options experience placing those trades. So I think it's one of those things that it is. Cover calls are easy until they're not, and then you go, what do I do here? So
I think you're anchored, by the way, in from a couple of years ago, because I think I'm at 31 or 32 years.
Oh, yes, you have a few more than me. That's true. But
I think you're more than 25.
I guess I might be now that you say that. Thanks for that.
Actually,
it is. You're right. Thanks.
That doesn't stay stagnant just because we said it one time.
Because we keep saying it. Listen, I got to get compliance to reapprove the new number, apparently.
Yeah, we keep getting older. That's
plus 25 plus.
I'm 30 plus now. So
yeah, there you go.
All right, I want to talk about earnings. Let's go there.
Okay.
I want to go.
Enough about Nvidia.
So here's all right, I'm going to be a little sarcastic about this. No surprise that when analysts, with all the earnings that beat this quarter that have come out, and then ending with Nvidia just smashing their numbers, analysts are raising their expectations. This is so uncanny that analysts, when things are going well, they raise their expectations. When things are going bad, they lower their expectations. Jay, our audience can't see this chart, but we've got a chart of what are the expected S&P 500 per share forward 12-month estimates, the forward 2-year, the forward 3-year. Across the board, they're like, nope, earnings estimates are going up. So the forward PEs went down, even though the market's up. Because E went up. The earnings estimates went up, Jay. But this is uncanny that, I'll bet you if you threw a chart of this against the market, they would look the same. You know what I mean?
Well, look, nobody says the analysts are perfect. They're not, right? It's like, your meteorologist, right? It's at times I think the meteorologist is more accurate than market analysts. But yeah, this is, market's going up. People are getting more optimistic. There's a lot of tailwinds in the market right now. And so they're given an excuse to push forward earnings up. Sure. And they've moved a fair amount, right? This pop that we have, even just the next 12 months, right? The forward estimate moved, just a week and a half ago, when we were talking about this, it was 230, 235 earnings per share. Now we're up over $242 earnings per share on the S&P over the next 12 months. Right. As you get to all-time highs, it's makes sense that they would push earnings higher.
Yeah, but this goes to the original point was, what can happen to change a forward PE? The price can come down or the earnings estimates can go up. And this is a case where the market went up, but estimates went up more And so the PE actually dropped.
The PE dropped, right?
Yeah.
Yeah. I mean, that's the thing. So this has been something you've talked a lot about the last month plus. That it's not just the P, it's the P divided by E, right? And the expectations of what the market is pricing in can change, and it's unknown, right? And that's that concept of the multiple. We hear from a lot of fundamental analysts that whether the market's cheap or the market's expensive based on this price to earnings ratio. But, there can be optimism that exceeds that, and it could turn out to be right. That even though it actually was cheap or wasn't cheap, right? I mean, because these things change, right? The forward look should not, you have too many things, too many, I'll say, variables to give you any kind of certainty when it comes to using PE ratios for your investing. And I think that's a point you've been kind of making recently when you show how earnings have some correlation. I've always said earnings matter to the price of the market. And you've said, yeah, but when you get the information doesn't necessarily line up.
I remember analysts get a bad rap too. And sometimes, who was it? What was the guy's name? Michael Kurlak was at Merrill. And this was in the late 90s. And he was, a lot of these tech stocks that had no earnings, no nothing, they kept going up and up and up. Well, he basically, his price targets were way below where the markets were. I'm doing this from memory. And he used to get like calls from the brokers being like, what are you doing?
Yeah.
And I get this, secondhand and third hand too from people who were there. But I remember reading it. Like he was a really big analyst back then on the street. And I think he followed Chips, probably followed Chips. If you Google it, you probably, I just Googled it. So he left Merrill. Kurlak dodged by lack of respect following Intel flip-flop. No context on that. But it's hard because if you're an analyst, and even if you're right in the long term, if price is going up or price goes down, I mean, it's good luck making predictions. It's a tough game. But anyway, a little sidetrack there, Jay. But let's get back to the earnings thing. You had challenged me, not really challenged me, but 2 weeks ago, we were talking about how stock markets 1 year to the next go up or down, and earnings from 1 year to the next either grow or decline or are flat. And we were saying it really doesn't matter. Like the market's forward looking. I went back and I looked and I said, I think I did this from 89 or from 90 forward. And I looked, is there any correlation between the S&P total return versus the trailing? So, what were the actual earnings? So let's say in 2022, what did the market do? And how much did earnings grow from 21 to the end of 22? And Jay, there's only about an 18.5% correlation, meaning what the market does, and I ran a regression and a scatter plot and all this stuff,
all
versus the earnings growth. There's not really a correlation. And then I did the same thing though, and I said, well, what if we took the market, let's say in 2022, and I did this for each of the years going back to the 80, 89, 90. What was the market in 2022? And what was next year's actual earnings? And was that a better predictor of why the market went up? Okay, the correlation almost doubled. It went to about a 34% correlation. A little bit better fit, and for those statisticians out there, the R square goes from about 3.4 to 0.34 to 0.116. But I wouldn't say there's not a lot of predictive value in here.
I mean, there's a little bit more correlation going, taking the year stagger. I thought it would be higher. So I guess I was kind of right? A little bit.
No,
but still, you're right. There's still plenty of times where, you have a change to the negative on earnings, but yet the market is up. And then the vice versa, right? Where you have the market down despite earnings being up fairly dramatically. I'm looking at this one data point. I don't know which year it was. I got to look in your chart where the, EPS went up 30%, yet the market was down, 11 or 12. So it matters Kinda. It's really more about the expectation of the market. But I think if all right, now you ready for the next challenge? When it really trends together, do they stay together? Right. And I'm looking here, it's the flip flops that get where I think the correlation gets missed. But, 4 or 5 years of growth in earnings also have 4 or 5 years of growth in the S&P, right? Like those kinds of, when you could cluster those together, maybe that's where it is. And it's the turn that seems to be off, but I could be wrong about that.
Like 2008 is interesting. So you go 2007. So 2007, the market's up only 5.49%. And 2008 earnings declined by 14.5%. And then 2008, the market's down 37%. 2009, the decline was 26.38%. And then, 2009, the market's up 26.46. The same year, their earnings declined 26%, but earnings next year were up 40%. So I think in that case, the market was pretty forward looking. I think that's not bad. If you go to 2019, where the market's up 31.5%, 2020 was down 12.5% earnings growth. Now, you could say, well, the market didn't get that right. I mean, okay, the market didn't know that shutdowns and all that stuff.
Yeah, it was coming.
Yeah, all that coming. So, yeah. But in general, I think it's really, you and I think would agree, and I'll ask you, over time, earnings go up, and over time, the market goes up. And we know that earnings, in the end, at some point, have to sync up with the market move. And I think earnings go up over time. And I'll bet you if you did a chart of one against the other long term, they'd probably be pretty similar.
So what's that mean? You saying they matter a little bit, but just you don't know when?
I'm saying as long as earnings are going up in the long term, you'd expect the markets to go up in the long term.
Got it. That, by the way, of course, that makes sense.
Nothing. I'm not saying anything that's any value to the audience right now. But just I think people get too caught up in this earnings versus the market. And we know the market troughed. What was it? October of last year.
Yeah. I just said it right. October 27th, I think.
Yeah. So it knew the market was smarter than everybody. It knew that earnings were going to recover, that interest rates probably, you and I can argue about, I think we're on the same side of this. Interest rates may get cut, but actually, let me pivot to that for a second. We have a little time. I think everyone is too focused on this whole, when are they going to cut? What's the number going to be? I think the most important thing is that they're just not going to have aggressive raising anymore. That's it. Like, it doesn't matter if they cut 25 basis points or 100 basis points. It's just if the hiking cycle is done, I don't know where you are on that. It doesn't matter if they cut. Like, the market doesn't need low interest rates to go up.
Yeah. So where I am on this one, I'm with you. I think it's the chances of them raising rates are fairly low, like single digit. There's always a chance of anything because you don't know what can happen, right? But it wouldn't be due to economic growth. It would have to be the inflation number, right? That has been their trigger, right? They've got two mandates, right? And one of them is the inflation number. So they don't call it that, right? How do they state it? Right? It's optimum employment and stable currency or something. Essentially,
stable prices and
something like that. But basically, they're talking about inflation. So like that. So there's if inflation popped to 6%. Yeah, I think they could. But low chance of that. Nobody's predicting that, right? There's, very little money on that side of that bet. But I don't know, Derek. I think it matters how many when it's extreme, right? The market started the year talking about 6. You and I thought that was way too much. I think that number is now down to 4 or 3 cuts. And the time of the first one also matters, right? So that's getting pushed out more and more. I think you and I have been in the camp of, all right, I think you're in this camp. Here's my camp, which is they're probably going to have to do one of them, at least one, and it might be more for optics, and they're probably going to wait till they, get closer to, say, September, right? We may get nothing. Now, the market is not putting money on that. The market is giving a 90+% probability in June or July in that time frame. So I'm on a different spot than the market, but the market was also saying, March was pretty much, a foregone conclusion, and now it is not. So when do we get PCE? This week, right? Is it Friday this week?
Yeah, I think so.
Right. That's the number that they use. They don't use CPI, but CPI is, usually a pretty good hint as where PCE is going to come in. So, so look, you're right. They don't have to lower. I'm still in that camp, but now it comes back to the yield curve conversation, which you and I have gone through multiple times, right? How does that normalize? And the market is not giving really any credence to the idea that Fed funds stay here and the longer end of the curve gets higher than what we're seeing right now. So, yeah, I don't know, Derek. I think the unwinding of the inversion is going to be interesting. I think maybe something for next week, we can talk about how long this inversion has been compared to other times when we've seen, the yield curve inverted like this, because it's been a while. We're going on over a year at this point, right? Or we're close to a year.
Yeah. Normally, this is the outer edge of where we would expect to see a recession start post yield curve inversion.
Yeah, maybe Nvidia stops the recession.
I keep going back to 94, 95. Yeah, because Fed hiked rates, no recession. Eventually, they lowered a little bit. Like, that's my scenario here. Fed hiked rates, there's no recession. Maybe they lower a little bit. They don't have to, though. I still don't know why they need to lower rates. There's no reason to if the economy is growing.
It's not unheard of to have this, Fed funds in this 5 range.
It's not even that high. That's the thing. The whole 1990s, we were around here. So it's, yeah. I also I'm a contrarian on if they lower rates, that it's going to cause more inflation because of housing. I don't agree with that. I think supply is sort of constrained right now because people can't, give up their 3% mortgage to go to a 6.5 or 7, whatever it is now, mortgage.
Right.
So higher rates are actually causing inflation because it's constraining supply.
Yep, we've talked about that kind of perverse reaction because of rents versus owning, buying property, those kinds of things, for sure. Yeah, they may lower CPI by lowering rates. That may happen. Yeah.
All right, I'll save our discussion of the Himalayan money market instruments for next week, Jay.
Darn.
I'm sure you're looking forward to that.
Darn.
Let's go to, we got some recommendations. Let me throw it to you.
So just starting to get into some of the newer shows that are coming out. So I started watching Halo. Sorry, I may give my little video game addiction away on that one. So on Paramount Plus. Yeah, it's okay. Not. It's more of a review than a recommendation. It's okay, right? If you haven't watched first season, it's just a unique thing. If you're not watching that, there's definitely some good shows coming out here that I want to keep an eye on. I watched Death and Other Details. I think that was the that's on. Oh boy, I think it's on Hulu. I've been enjoying that kind of a murder mystery. Pretty good, pretty well done murder mystery show.
Yeah. Okay. All right. I can't, the superheroes and the video games I can't get into, but for those in the audience,
you're too serious of a person for that. I understand that.
No, I like comedies. I wish they made more comedies than.
It is Hulu, by the way. I just Googled Death and Other Details is on Hulu.
All right. So I finished watching True Detective season 4 and I liked it. I thought it was good. It was only 6 episodes, so we'll give anything away about that. By the way, I want to clean something up. I addressed this earlier on an earlier episode, but somebody was like, I can't believe you don't let your wife watch your Netflix account. And it's not that she can't watch Netflix. You each have our own profile, okay? Or each have our own profile. And so what I did was, if somebody wants to watch on my profile, you have to enter a PIN. But there's 3 profiles when you go there. So no, she's not locked out of Netflix. I've not done that to my wife. I don't want her watching on my profile because then I get if you love Kissing Booth, you'll love Kissing Booth too. No, I don't love any of those movies. So
here's just create another profile for yourself, dude. Let her keep watching that one. It's okay. Rename it. It's probably at the top, so that's what she's watching, right? So
right, but I have a pin on it now, so now she's on her own.
Pin on it.
You put a pin.
Oh my gosh!
Put a pin on it. So I haven't watched it yet. I'm excited. F1 season starts next week. Formula One racing, and F1 Drive to Survive. The new season is out. So that's on Netflix. You can binge watch it. So that's my
binge
recommendation
worthy for sure. Definitely binge worthy. They did a good job.
Did you start watching F1 or you just watched the show?
No. Well, it's not the easiest to get. Like I haven't figured out between my schedule and where I can record it and then watch it later. So no, I watched the show. How do you watch Formula One?
Well, it's normally on ESPN, except for the races in the US that are on ABC. So most of the time, at least West Coast, they come on anywhere from 5 a.m. or 1 a.m. to 8 a.m. So you tape ESPN or ESPN2 and you just watch it or you watch it live.
Yeah. Okay.
And sometimes it's on ABC, like the races that are in the afternoon, like the Brazil, Miami, for example, the one out by you, that will be on in the afternoon. So it's good. And a lot of people like the racing. I like the strategy of it. Like, they're going to go how many laps on these tires? Oh, they're going to do that. Like, I like the strategy of when you pit, when you don't pit, how long the tires are going to go, that type of stuff. So,
okay,
there you go. All right, that's it, Jay. Back next week. See you, everyone.
If we get another new high next week, Derek.
I think we do. Oh, are we both in agreement?
No. I'm still on my 4,900 before 5,150, but I hope you're right.
Yeah, another new high. We've had 12 or 13 new highs this year, right?
At least.
All right. We'll let you know what happens next week. This week. See you, everyone.